G'day guys, welcome back to the Devon Too Good investing channel. In this video today, we're going to be doing a stock analysis deep dive into Thor Industries. So in this video, we're going to discuss Thor Industries' business model. We're going to talk about their competitive position within the RV market. We're going to be talking about some of the headwinds and tailwinds within the RV industry. We're going to be talking about the financials of Thor. We're also going to look into Thor's management team to see whether they have integrity and talent. And then we'll cap this video off with a valuation so we can sort of get a guide on what kind of price we would want to pay for a business such as this. So before we get into it, guys, please subscribe to my channel and like this video. So on a very high level, Thor Industries designs, manufactures, and sells recreational vehicles, also known as RVs, and they also sell related parts and accessories. They operate in 3 different markets, being the United States, Canada, and Europe. So let's touch on the business model. So there are 3 main stakeholders within the business model. The first one being Thor Industries, who are the manufacturer. The second one being the 3,500 independent dealers of which Thor works with. And then obviously the third stakeholder is the customer, who the independent dealerships sell the RVs to. And the important thing to take out of this is that Thor Industries and the 3,500 independent dealerships that they work with must work in tandem to manage supply and demand within the industry. So pretty much when the independent dealerships inventory becomes low, they'll put in a order for Thor to manufacture more RVs, and then that will replenish the inventory levels once Thor has, delivered these new RVs to the independent dealers. And when inventory or supply demand dynamics are not managed well, what you'll see is the independent dealers will have too much inventory, and then as a result, they will not order new RVs from Thor as they already have enough inventory. And this is where you see the cyclicality within the industry. So if you go back to 0809, pretty much demand dropped off from customers, so independent dealers ended up with more inventory, so Thor ended up, having a major drop in their revenue. The same thing happened, with inventory in 2018, 2019. So in 2017, there was a big boom in RV purchases. As a result, that they were projecting more growth into the future. This growth ended up not happening, and the independent dealers had too much inventory. As a result, Thor didn't get new orders from the independent dealers. But if we look at the financials here, despite the cyclicality of the industry, you can see that over the long term, over the past 9 years, Thor has had some significant growth within their business. So between 2012 and 2021, they grew revenues at 16.6% per year on average. You can see gross profits have grown 20.4% over that period. Same thing with net income. Same thing with adjusted EBITDA at 22%. Same thing with diluted EPS, 20% growth per year. And then very impressive numbers here also with the cash flow from operations of 18%. So you can see, despite the cyclicality within the business, if you look at the long-term trend, it's clearly growing here. Now let's talk about the future growth prospects for Thor Industries. So Thor, they grow in 2 main ways. The first way being organic RV demand growth, and the second way being market share growth via acquisitions. So if we first talk about organic RV growth, I think it's likely going to be flat compared to 2022 over the next 5 years. And this is mainly due to the current macro environment. So obviously we're seeing increased interest rates due to inflation. As a result, this is hurting consumer confidence. And we're probably going to see a pullback in demand for RV products. But we're also comparing, we're also going to be comparing results to the 2022 results. And quite frankly, the 2022 results were elevated and they were really excellent, to be honest. So in 2022, the RV industry in North America delivered, it was like 600,000 units. And in 2023, they're predicting 419,000 units. So we're seeing a fairly large decrease in demand here. If we talk about the market share growth via acquisitions, the management team have noted that there will be no more acquisitions for the next 3 years. However, they have already made significant acquisitions in 2020 and 2021. So over the next few years, we should probably expect growth from these acquisitions, as Thor actually have a good history in delivering high returns on invested capital from their purchases. So if we talk about the RV industry in general, it's pretty much a oligopoly industry where there are only a few key players with high market share that pretty much dominate the industry. But it's also very cyclical, and demand within the industry depends heavily on macroeconomic factors. It also depends heavily on the supply side constraint shown by these RV manufacturers, because if they oversupply their dealerships that they're partnered with, the dealerships are going to end up having too much inventory and then not ordering more inventory from the manufacturers, and this results in a very cyclical industry. But we do have some positive long-term trends for the industry as well, which should support future growth here. Millennials and Gen X are entering the industry, and they're entering the lifestyle. And if we have a look at the long-term retail outlook, in calendar year 2027, it is projected that retail will be between 885,000 and 630,000 units for the North American RV industry. And if we look at the trend over the past 5 years, you can see that it's pretty much grown at 7% per year. And you can see there was a big boom year in 2021 of 600,000 units. Apologies, because in the previous slide I said this was 2022, but you can see the actual 2022 estimate here is about 500,000 units. And then, as I mentioned in the previous slide, about 419,000 units sold for 2023. So you can see that you can just see the cyclicality in the results here. So you can see in 2000, around the dot-com bubble, there was a decrease in demand. Demand then ran up between 2022 through to the GFC, where we saw a huge decrease in demand. And then demand pretty much ran up again all the way through to 2017, where in 2018, 2019, and those 2 years, the market was oversupplied due to the big year they had in 2017. Everyone was too optimistic. And as a result, the dealers had too much inventory and they stopped purchasing from Thor until these inventory levels normalize. And then you can see the huge run up here in 2021 due to the tailwinds caused by COVID, with obviously stimulus and borders being shut, and buying an RV with the very low interest rates and the border closures became a very attractive proposition for people wanting to take vacations. So we mentioned in the previous slide that the RV industry is pretty much an oligopoly. You can see here that only a few key players dominate a large majority of the market. As of 2021, in the towable segment, Thor had 40.9% market share. Forest River, I'm pretty sure it's owned by Berkshire Hathaway. They pretty much operate 38.1% of the market. And then you can see these smaller players here. So the towables is pretty much dominated by 2 competitors. And then if we look at motorized, you can see Thor dominate 47.5% of the market here. Forest River, 20.1%. Then we've got Winnebago here with a decent share of the market of 18%. But you get the deal. It's pretty much an oligopoly run by a few key players. And if we talk further about Thor's competitive position, they are market leaders in every segment within the North American market, whether it be the travel trailers, the fifth wheels, or if we look at the motorized vehicles, Class A, Class C, and Class B. And in Europe, they are the second largest player with 18% market share. So we did mention earlier in this presentation that Thor do have a history of making acquisitions, and these acquisitions tend to contribute to their growth and also their future growth prospects moving forward. And we can see that they've actually had a very impressive track record in terms of success with their acquisitions. So you can see that they purchased KZ back in financial year 2014, and since that acquisition, they've actually increased sales of that business by 154%. You can see the same with Postal here, 53% growth. Cruiser, 131% growth since the acquisition in 2015. We can see growth here with Jayco. We can see growth here with Owenheimer, which is their European acquisition. And we can see growth here with Tiffin as well. And this is also highlighted by a very high return on invested capital as well as return on equity, where over the past decade, they've averaged high teens return on invested equity. So this just goes to show that they are effective with making acquisitions. Just to, drive the point home here, we can have a look at their return on equity since 2007, and you can see that it's fairly consistent, above 15%. You do have a few years here where they do struggle a little bit with return on equity. This is during sort of slowdowns in the cycle. But if you normalize it and take a median, you get 17.9% as return on equity, which is, it's a great sign that Thor is a compounding business. So I think a good case study for us to look at is how did Thor perform during the 2008-2009 GFC, and also how did it perform while the market was oversupplied back in 2018 and 2019. So if we look here, we can see that shipments fell 53% from 08 through to 09, and we can see that revenue also fell about 50% in line with the decrease in shipments. But we can see gross margins, they did decrease. However, they didn't drop as far as revenue decreased. And as a result, Thor actually stayed profitable during the GFC. You can see here, they stayed profitable. And then if we look again at the next case study, if you look at 2018 through 2020, shipments fell 32%. And if you look at the margins, they stayed, they decreased a little bit in 2019. However, they stayed reasonably, in line. And if you look at revenues, they fell with the shipments, but Thor remained profitable despite, the tough market conditions. And there's a few reasons how they do this. So how do they remain profitable? Well, during downturns, they have some levers that they can pull. So they're able to reduce production rates and quickly consolidate production plants. So Thor have two major expenses. One is pretty much raw material cost, and the other is labor cost. And they're able to reduce some of these costs by pulling back production rates. So they'll shut some of their factories down, and they'll consolidate production plants to limit overhead cost. They can also, unfortunately, decrease headcount, which obviously decreases labor cost. They can freeze or limit capex, and they can lower their maintenance capex. as well as compensation is variable. So when Thor is going through a tough time, management compensation automatically becomes lower, and this is how they remain free cash flow positive even during downturns. With any business, it is important to have a look at the balance sheet and understand the debt and understand the liquidity position of the business, and it's especially important with cyclical businesses that go through, booms and busts. So, they do have a bit of debt. They have about $2 billion in debt. Currently, they have $329 million in cash on the balance sheet. And they also have $870 million available in a credit facility, which they can use if they choose to. But if we look at the debt, they're fairly reasonable terms. Their largest part of the debt, their TLB, is due in financial year 26, and it has a weighted interest rate of 4.59%. And then you can also see the unsecured notes debt here. It's due in 2029 and is fixed at 4%. So all their debt is fixed. They've got liquidity right now that could pay back half their debt. We've also seen that Thor continue to make money even during downturns. And while this debt is fairly significant, I think debt in the case of Thor is actually okay, just because they've got a higher return on equity. So the fact that they're a little bit levered here means that they're able to sort of lever their growth, and if they've used this cash, or if they've used this debt to then purchase acquisitions and then returns on equity of like 17%, which they've historically done, then this will end up being a good thing for the business. And over the next 5 years, Thor should comfortably pay down this debt, as we'll see in slides further in this presentation. So let's have a look at Thor's management team. You can see their CEO, his name is Bob Martin. He's been with the company for 21 years and has 29 years of industry experience. And you can see the rest of the executive team here. They're pretty experienced. You can see that they've all been at Thor for a reasonably long time, 11 years, 10 years, 18 years, 5 years. And they also have extensive industry experience, as you can see. So that's it's a good sign. If we talk about their capital allocation, they tend to allocate capital in 5 different ways. So the first way is liquidity. This is just to bolster the balance sheet. They also like to invest into their core business, and this is their first priority. They're looking at making investments in their business to keep modest maintenance capex. They're also looking at smart capacity expansion, automation, which should increase margins. They also prioritize repaying debt, and you can see that in the past, whenever they've had debt, if you look at their historical sort of cash flow statement and balance sheet, you can see that they do look to decrease debt pretty quickly after making an acquisition. And they look to keep long-term net leverage ratios of below 1 across the business cycle. They also like to distribute cash to shareholders. They've had an annual dividend that's been growing at like double-digit rates over the last decade. And they also have been repurchasing shares, which they will continue to do so as they think that their business is currently undervalued by the market. And then in terms of acquisitions and growth opportunities, as we mentioned before, there is currently no planned major acquisitions over the next 3 years. So this slide illustrates what I mean by them being very prudent in repaying debt. You can see that they did have a bit of debt here back in sort of that 2016 timeframe, and very quickly this got paid back. They made a big acquisition here in 2019. This was the Erwinheimer acquisition, and you can see that on this bottom axis here, that they are constantly paying back debt. And you can see even in 2022, they have almost paid for that acquisition they made here entirely within 1 year. We talk further about the dividend and the buyback. You can see that they've had 12 years of consecutive dividend hikes with a 10-year CAGR of 11.1% for their quarterly dividend. You can see back in 2012, it was 15 cents. And then, it's grown considerably to 43 cents here in 2022. They have recently authorized an additional $450 million repurchase program. And once they buy back all the shares, they expect that they'll buy back about 14% of the current market cap by 2025. And this equates to over $875 million of capital returned to shareholders over the next 3 fiscal years. So if we talk about management compensation real quick, you can see that this very right column here shows us what each of the executive team made in compensation, in 2021, 2020, and 2019. And you can see their compensation has increased quite dramatically in 2021 compared to 2020. Bob Martin, CEO, he made $19 million in compensation in 2021. However, we have to keep in mind that this compensation is variable based on business performance. So I would strongly suggest that this compensation will be less in 2022 and then less again in 2023 as demand in the industry drops. In terms of their base salary, I'll call it pretty modest considering the size of the business. And you can see most of the compensation here is awarded via share awards and non-equity incentive plan compensation. And this is obviously dependent on the performance of the business. So honestly, no major red flags here. I think it's fine, to be honest. So if we talk about insider ownership of the company, so the co-founder still owns 3.5% of the company. You can see here his name's Peter Orthwein, and he has almost 2 million shares here. And also the CEO, he owns about $16 million in stock. It's not a huge amount compared to his compensation. We'll see, if he ends up purchasing more. However, it is, it's still $16 million. He's still got some skin in the game. The co-founder definitely has big skin in the game here. I'd like to see, this potentially being a bit higher. However, it's not, I wouldn't call it a red flag. I'd just call it a bit of a, yellow flag here. And if we look to see what insiders are buying or selling, you can see the majority of the recent insider transactions have been purchases. You can see that, the co-founder, Peter Orthwein, he has been buying shares. He's bought some more shares here recently. He bought 20,000 shares at a price of $72.50. And this was, only on the 4th of October of this year. So, we're not seeing the management team dumping their shares. In fact, we're seeing the opposite, and they are contributing shares. They're increasing their share ownership, I should say. Another good sign is that the management team do have a history of keeping their promises. So back in 2019's Investor Day, they announced some 2025 goals. They were looking to hit $14 billion in net sales, gross margin of 16%, and deliver $3 billion in accumulative net cash from operations going out to 2025. And as of April 30, 2022, they actually beat these numbers, way early, 3 years early here. Achieving net sales of above their target, achieving gross margins above their target. Then obviously the cash flows aren't there, but they're obviously well ahead of schedule in terms of their cumulative net cash flow. So As a result, because of this, they actually adjusted their long-term targets, and they updated their 5-year target out to 2027. Thor projects about $20 billion in net sales, a sustainable gross margin of 17%, earnings per share of $27, and a cumulative net cash from operations over the next 5 years of at least $6 billion, as well as a reduction in greenhouse emissions by 40%. And some of their drivers here are that they think that calendar year 2027 North American retail, demand is projected to be between 585,000 and 630,000 units for the RV industry. They're assuming that they're going to maintain market share. They're also assuming that there will be a return to a normalized level of promotions and discounting. They're also assuming that the European business segment increases their gross margin by 200 basis points. They're also looking at expansion of the service and aftermarket sales. This is one of the recent acquisitions they made. So they're looking to get into the services and parts business. And then also assuming that they can make some acquisitions. This will be obviously between the year 2025 and 2027, most likely, as well as they're able to offset inflation with pricing. We have seen that they've been able to successfully do this so far. As I've looked through the numbers and I've checked their average selling prices, and they have been increasing pricing to offset inflation. So with any investment, there are risks here. So let's talk about some of the risks. I think the biggest risk is mostly macro related. So for example, if you have a bad macro where you have high interest rates, high inflation, and potentially high unemployment, this will obviously lead to lower consumer sentiment. And if you have lower consumer sentiment, this will lead to lower RV unit purchases. I do believe there is also potential supply chain risk within the industry. For example, there is currently a semiconductor shortage affecting the European business with their motorized vehicles. So as a result, there is a supply risk there at the moment. There is also a reliance on raw materials such as steel, and also a heavy reliance on labor, which obviously could be affected by the availability as well as spot prices for the raw materials. And obviously there could be a risk of the inability to pass the inflationary costs onto the dealerships, and then obviously the dealerships onto the customer. However, so far they have been successful in passing on these costs. So far so good with the inflationary sort of price increases. The semiconductor shortage at the moment, that should ease up, going into next year. And it could also provide a bit of a tailwind next year in terms of the European motorized segment when this sort of shortage does ease up. Obviously, they are at the mercy of steel prices for manufacturing, as well as at the mercy of labor cost, and just availability there in general. So it is always prudent to look at the downside scenario. So this is Thor's downside scenario that assumes a 35% drop in revenue. So this would result in net sales of 10.7 billion, gross margin of about 14%. You can see down here, they're still going to remain profitable even in the downside scenario where revenue drops 35%. Still doing EPS of about $6.70. So, trading at roughly a PE of 10 in this downside scenario. And then cash flow from operations, 640 million, which you can see here. It's not really that bad, is it? Considering that the business's market cap's, in the $3 billion range. So let's talk about valuations. So when I value cyclical businesses, I like to use book value. So I am going to do a discounted cash flow for this, but let's talk about book value first. So if the price to book is of 1, that is the theoretical replacement value. So if you were to buy the business at a price to book of 1, it would mean that you get all future cash flows for 3, as no future cash flows are currently being priced in. And if we look at the price to book chart here for industries, you can see that currently it's at 1.08 times book. And the mean over the last 15 or so years has been about 2.58. And historically, buying for industries at a book value of about 1 has resulted in excellent returns. You can see back in GFC, it got below 1. And, within a couple of years, it got back up above 3. Then if you were patient enough to wait, till 2019 here, you could have bought at about 1 again and ran it up. And then, of course, during the coronavirus, March 2020 stock market crash, you had another opportunity to buy Thor at below a book value of 1. And you can see here that it's, done pretty well. You would have tripled your money just on, book value multiple expansion alone. And again, in 2022 here, you can see that we've got a similar opportunity. Now, I think one important thing to think about is, look, if they were to go into liquidation, which obviously is extremely unlikely, you're probably not going to get all of this book value back as a shareholder. Some of this book value here is intangible. Obviously, intangible book value is still worth something, but it's not real hard assets. But just from a quantitative perspective, you can see that, pretty much whenever it's below 1, historically over the last 15 years, it's been a good time to buy Thor. So the current price to book per share is $66.93. And since 2007, book value has grown at a median growth rate of 17.9% per year. So over the next 5 years, I'm predicting conservatively here that book value should grow at about 8% per year. So if we grow this current book value out by 8% per year, in 5 years, in 2027, we should have a book value per share of $98.34. So since 2007, the median price to book ratio was 2.58. And by 2027, I'm going to assume that this price to book will re-rate to 2. So it's still going to be below the median price to book. And this is a bit of, just a conservative guess here, because it's, obviously very hard to determine where the price to book will be in the future. But in this case, it would infer a 2027 Q3 target share price of $245.85. And from today's share price of $72.40, this would imply a CAGR of almost 28% per year. So as promised, I've also done a DCF method of valuation for as well. So in this valuation here, I feel like I've been pretty conservative. So I've assumed that free cash flow is actually going to fall. So in 2022, Thor did free cash flow in the $700 million range. So I'm going to say it's going to substantially decrease and be about, $400 million. And I'm going to use conservative growth rates here of between 8 to 16%, keeping in mind that this is coming from a very low base if this, valuation does play out. And I've used a terminal multiple of 16. This is their average PE ratio over the last 5 years. I put in shares outstanding, and then I've also put in their net cash. And obviously they got more debt than they do have cash, so this is a negative number for the valuation. And you can see for a 22% return, I'm getting buy prices of, between $49 and $77 per share. Again, this is conservative. This is actually probably more conservative than the estimate that Thor gave in this previous slide about their downside scenario, because you can see here, Cash flow from operations in downside scenario, 640 mil. If we go back to the valuation here, I've used about 400 mil. Obviously, this is free cash flow, not cash flow from operations. So in Thor's downside scenario, they're not including maintenance capex. In this one, I am including capex. But nonetheless, you can see it's conservative, and you can see the buy prices if we factor in the debt here, keeping in mind that they should be aggressively paying this off over the coming years. But guys, in conclusion, Thor is a dominant business in its industry. They have about 40% market share. Even when they go through downturns, they're able to decrease expenses in line with demand in the industry to keep their margins up and to remain profitable. There are some long-term growth trends in the industry with millennials and Gen Xers entering the RV lifestyle. They are currently facing some macro headwinds, hence likely, why we're seeing the share price as it is right now. However, you look at the financials over the last sort of 10 years, and you're seeing, mid-teens growth in sales, and in terms of EPS growth, you're looking at like 20% CAGR per year over the last 10 years. So despite the cyclicality, if you look at the long-term trend, it's definitely a business that's compounding, and the management team are quite effective, as shown by their return on equity, which has been about 17% over the last decade. So if you factor in all that, and then you factor in that they're trading close to book value, and I've used very conservative assumptions here on the DCF. Look, I can't make any recommendations. So obviously use this presentation however you like. Make sure you do your own research. However, it seems like a strong business, and you can see the valuations. So I'll leave that up to you to figure out. But guys, thank you for watching. This has been a long video. So if you stuck around to the end, I appreciate it. Might as well hit the subscribe button, and thank you very much for watching.